I'm going to give you an example on how to use ICT to trade. So on the daily, first you map the areas where on the PD arrays. Like here we have a bearish order block. Then you drop to the lower time frames. First to the 1 hour time frame. And you refine that area that you have on the daily, that you have mapped on the daily time frame, and you have this fair value gap on the 1 hour OCB, which is the bearish fair value gap. Now, after you have marked the bearish fair value gap on the 1 hour, which is here, then you drop to the lower time frames again. Let's drop to the 5-minute time frame. And you go back to the origins of that 1 hour fair value gap. Which is here. You find a buy side liquidity level and mark that out. So by the time, let's use bar replay for this. By the time the 5-minute candle touches into one of these buy side liquidity levels on the 5-minute, you wait for the 5-minute to do a engulfing candle to the downside, a bearish engulfing candle to the downside. Now we haven't got that yet. This setup is not as good because it took 1, 2, 3, 4 candles to engulf this green candle. It would be better or more high probability if this one candle engulfs this green candle, but this is still okay. This is called a dominant break, where 3 or more candles break one candle, in this case to the downside. So we have our CISD here. You enter short right at the close of this candle that broke this upside candle to the downside, and you put your stop loss up there, and that will be around 33 something pips stop loss to entry. Now your target, you use your higher time frame. You have an order block here on the 1 hour, and you also have a fair value gap beneath that. So I would use ignore the order block. Price might react here, touch into the order block, and then slightly go up, but I think the drawn liquidity shouldn't be this order block. Why? Because price moved to external range liquidity after breaking this high. I'm going to use green or yellow to make it pop, and this high. So after price moving to external range liquidity, price has to seek internal range liquidity, and there is no other internal liquidity besides this one. This is the closest internal range liquidity available. So I would use this on the consequent encroachment, either the upper quadrant of this fair value gap as my target. So let's drop back to the 5-minute and let's get rid of all these illustrational lines. So the trade would look something like this. The trade would look like something like this. So let me get rid of this. This is your entry. Over here is your stop loss, and your target would be either the very top or start of the fair value gap on the 1 hour, which would generate you, if it hits target, it would generate you a risk to reward of 3.38, or you could use the consequent encroachment as your target, which will generate you a risk to reward ratio of 1 to 4.29. Or what you could have done is you could take partial profits over here at the lowest hanging fruit, so to say target, then there, and leave a portion to take profit at the consequent encroachment of the hourly fair value gap. Now let's see what happens. It's too slow. I'm gonna use 3 times speed. So there you have it. Simple, and it works. Thanks for watching. Hope to see you in the next one. Bye.